Welcome to Syndication Nation from Cloud9fin, where we're talking syndication, banks, bonds, BSL, buy side, and everything else in liquid leverage finance. I'm Dan Mika. I'm a leverage finance reporter with 9fin's editorial team, and I'm glad to welcome to the pod today Dominique Toublan, the head of U.S. credit strategy at Barclays. Thanks for being here.
Thank you for having me.
So I'm really glad that we got to get this going a couple of days after the jobs report, because I've been thinking a lot about the balance between macro data risk and tentacles and how that's driving credit spreads. And I'm really glad that you're here because Barclays has the capitulation and complacency signals report. So for listeners and viewers who aren't aware, just give us a quick overview of what that is and what it's meant to measure.
Perfect. Yeah. So these signals come from a desire to understand a little bit better where the demand is at, right? Because very often we can talk to investors, to clients and say, what do you think? Where are you positioned? But, what they're going to tell us is maybe not everything that they do. And so the question is, can you find some things that you can observe in the market in an objective way? Flows, positioning, is implied vol high or low, and put that into a signal that is essentially telling us when the market is stretched one way or another, right? So for instance, on the capitulation one, suddenly the market, any non-negative news is going to be received positively because people are just given up. Same thing on the complacency side. At what point is the market so stretched over their skis in some sense? Can I measure this? And what we try to do there at the same time is to also say, how far are we from they're really stretched and we're going to be close to the tights. So what we put together again is a certain number of objective metrics, put that together, backtest it historically, and do the signal for us something that, is the wides, the tights. And what we do as well there is we don't like to rely on one number only because there can be some idiosyncrasies around that number, but a combination of 8-9 different numbers to say, aha, now there's something going on. So if you look at the recent, the data points, what did we see? Early in the year, we started to be quite stretched on the complacency side and spreads were very tight. Now, when you got to Liberation Day or a week or so after, the capitulation was very high. We almost triggered. So that helped us saying, maybe now it's time to go back into the market. Maybe you start with the safer bonds or the safer loans rather than the more risky one, but the market's likely to change. And then you combine that with discussion with people. What do we see on the trading floor as well? So try to combine the measure, if you want, the signal itself, and what we observe in the market. And that gives you a good perspective on whether we should change tack and be more or less constructive. On the tight side, we got, again, relatively a stretch, but not a ton. Since Liberation Day, we've never been really, really stretched. We've been, I would say, in a normal position for that complacency or capitulation signals. What's happened, though, in the last week with the weaker numbers, we've started to see a little bit of deterioration in that perspective. And that comes, from, again, some of these objective measures. The flows were not quite as strong, implied volatility increased a bit. So a few of these numbers that we look at got a little bit weaker in some sense. And that is really lined up with what the conversation we have with investors. Investors are still cautious. They still have quite some fears about the tail risk. And therefore, most of them are relatively close to home. And so I don't feel anybody is really stretched when I talk to them. So it lines up, if you want, data qualitative approach and the more anecdotal perspective seems to line up pretty well right now.
So one of the reasons why I found this helpful, particularly after the week jobs report on Friday, where there was a miss to both the numbers that were supposed to come out last month and then also in revisions, was that credit spreads did finally move up a little bit. But it seems like a lot of that was not due to high yield and leveraged loan traders selling off, but more just a move in treasuries. Is that right?
So there was a combination of a little bit of everything, as you say, which is correct. The treasury yields have fallen a little bit. A lot of the demand we've seen is yield focused, and spreads are an afterthought for many. Right, the big picture that we all know about is the high yields we've seen since the GFC, and some people are really attracted by these yields. And as long as credit fundamentals are okay, they don't need to be great. They just need to be okay. Credit spreads suffer from it, if you want, in the sense that they can stay tight for some time. And so what we've seen is the demand remain strong. That said, we did have some moves late last week, earlier this week on some of the lower part of the rating spectrum, where you saw people being a little more cautious on the cyclical side as well. So you did see some differentiation across the different parts of the credit markets, of the part that are most sensitive to the tail risk, the most sensitive to the risk of stagflation that these numbers indicate, underperform a little bit the rest.
Mm-hmm. So part of the bigger kind of my Roman Empire, so to speak, as a journalist, particularly since Liberation Day, we've seen so many headlines, so many changes in the world that, to me and to some of the people that we speak to in the market, should have been things that have blown out credit spreads, that should have created more capitulation in the signals, right? For example, multiple rounds of tariff threats being thrown around, the U.S. striking Iran, potential questions around the Fed independence. Just so many things that have happened since Liberation Day, where we are now at a point where spreads are generally lower than they were pre-Liberation Day. Why was the jobs report the thing that sent credit spreads a little bit higher? Why was that the catalyst versus all these other things that have happened in the past couple months?
Great question. I think the key thing here is that so far until last week, the hard numbers were still okay, right? So if you look at inflation, it was not really popping up. If you look until the revisions at the job numbers, they were still fine. And so the market had been very worried about the tariffs, and so very worried about that tail risk, and what is sensitive to the tail risk underperformed really a lot in April. Now, Trump comes out, says, we're going to slow down on the tariffs, we're going to negotiate with people and all this. And people say, oh, it's like 2018. It's going to come to some agreement that is not as bad as the opening. And so the market then looks at, again, more the hard numbers, and nothing is really transpiring. It looks like the tariffs have very, very little impact. And so the market moved from 2 months ago to I'm very worried about the tail risk to now I'll believe it when I see it. And last week is when we have I'll see it because the NFP is no good. And what's happening there is, if you put it in context, or the 3 months or 6 months rolling NFP numbers is the worst since 2011 outside of COVID. So it's really a light print. And then people suddenly are worried because of what has helped spreads stay relatively tight since COVID, because the consumer has been spending. The reason why the consumer has been spending is unemployment has been low and wage growth has been significant. Is that going away? If that is going away, then we should reprice everything, right? And so I think that's why you see the market reacting to this, because the consumer is the core of why the US was different from Europe, let's say, since COVID. And that weakness in the hard number is what people were waiting for to be more cautious. As you can see, we didn't widen a lot. We're still relatively tight in spread levels. So people want confirmation of these numbers in many ways. But that is essentially the first time that you had a relatively consensual picture of saying, well, look at the first half growth. I know quarter by quarter has been volatile, right? But if you look at the first half, you have about 1.2% real growth. The second half of 24 was 2+. So we did slow down. And then the job numbers, the weakest in quite a while. And then if you look at the ISM, manufacturing, services, both of them having flavor of stagflation there. Credit spreads don't like stagflation. So that's why I think you see people a little more cautious here and trying to gauge what's going on, and maybe a little bit of wait and see mode to see what to do next. That said, the demand for yieldy paper is still there. As long as people find the credit story behind it is okay.
So I'm also wondering how you're balancing the questions around the macro economy versus the technical drivers in this market right now. There's been plenty of inflows all this year, right? A lot of paper, a lot of inflows chasing that yieldy paper, but there's still not a lot of new paper in the market, right? And you mentioned the word repricing there, and I'm sure a lot of our analysts listening are having a little bit of a flashback to just the past couple of weeks where we've seen so many credits, so many issuers go to market and say, we'd like to reprice our loans, please. Thank you very much. Cut 25 or 50 basis points here or there to the tune of, I couldn't even count, but quite a bit. So how do you think about how a credit analyst, how a portfolio manager should think about weighing the macro risks versus just the technical tightness that is driving this market?
It's a very tough one, right? Because again, the numbers so far have not been so bad until this week. If we have confirmation of these numbers, is a different story. But the demand is strong, and if you look at the earnings so far, they've been pretty good. We have a cool other metric that we put together. It's called our earnings scorecard, where you ask our analysts to look at the results versus expectation, but also the guidance versus expectation. And then they're like a grammar school teacher and give a grade, from 1 to 5. And this score is pretty good.
Mm-hmm.
There's some exceptions, but by and large, it's pretty good. So on the pure credit perspective, it looks okay. And the guidance in some places is a bit weaker, but it doesn't look dramatic. But profit margins are still high.
So right now, where it's from, A, B, C, D, F, where are we right now?
You mean on 1 to 5? We are 3.5 right now.
3.5.
Which is one of the best scores we've had in the last 6-7 quarters. So again, and if you look cyclical, non-cyclical financials, they're all recording pretty decent numbers. And so the conundrum here for investors is this, okay, most people believe that you will see some impact on the tariff, maybe late third quarter, beginning fourth quarter. Now, do you believe it's a one-off? And then 2026 is better. The growth perspectives are higher. The Fed's going to cut more time, but that's what the market is expecting. Or do you believe that it's going to last a little bit longer? So for those who believe the base case is it's going to be a one-time thing, then they'll see through it. As long as yields are where they are, the demand will stay robust. But if you think it lingers for longer, then it becomes a different question. So that's the difference I see when I talk to investors. We are more in the second camp, where we think spreads should be wider, a bit wider by year end. Not a lot, but a bit wider by year end, because of that pressure is to start to see on the inflation and on the consumer spending. But I can see how you can build a coherent narrative saying it's going to be a one-off, and I should see through this and keep on investing. Because as you said earlier, the amount of demand is so strong, right? The number I have in my head is on the high grade side. I know you focus more on the LevFin, but just to give you the number, in July, in investment grade, the gross issuance was not bad at all. But the maturities are very high because we are 5 years after COVID. 5 years ago, cash was king. A lot of bonds were issued. 5-year bond is a standard, maturity that you issue. So a lot of that cash is coming back. The coupons are also higher, right? Just because the yields are higher. So if you look at the issuance in investment grade in July, net of maturities, net of coupons, it was minus $40 billion. There's not enough paper out there. So any marginal increase in demand, where does it find that these bonds to buy? It's going to buy it at relatively tight spreads. So that continues to be the big driver of this market that keeps a lid on the spreads, is that demand is strong, and it seems to be strong as long as you have what? 1, high enough yields, and 2, no big headwinds coming from credit fundamentals. And so far, we're still here.
So let's pivot just to the rest of the year. What are you looking forward, both in high yield and in leveraged loans? What does the rest of the year look like for you? And what's one thing that you think the market should be paying more attention to?
So on the spread or price direction, we think we should be wider a little bit. So in high yield, it's around 40 bips wider than where we are now or so. So a little bit of a sell-off, but really not large compared to long-term history. And so again, because we think the impact from the tariff will be felt a little bit more strongly than what investors are saying. The overall place I would look at is, do we see some people going over their skis? Because as we discussed at the beginning of this podcast is we see complacency on the higher end, not stretch, but higher end. If we start to stretch too much, that's going to be the signal there. So are people becoming too aggressive? Because in many ways, when you are in a situation like this, the temptation is to reach out for the extra yield. Do you reach out in a way that is safe or pushing too much? And that's what I would look at. So look at the new issuance. How is this priced in? Is it very aggressive, not aggressive? Look at the triple Cs. The triple Cs have lagged. Do we see some aggressive moves there in the triple C space? That would be the places where I look for, are we starting to be too stretched?
Well, Dominique, thank you so much for being here. Really appreciate the conversation.
Thank you.
And thank you for listening to Syndication Nation from Cloud9Fin. If you have any thoughts or feedback, we'd love to hear from you. You can shoot us a note at podcast@9fin.com. Have a good one and take care.